Good afternoon, everyone, and welcome to the Retirement Planning webinar. This afternoon, we have kind of excited about this one. We have one of our very own financial advisors, Kevin Massey, talking today about achieving financial freedom. Before we get started, I just kind of want to let everyone know that you'll be able to ask questions in the chat. I will not respond to everyone. I'll respond directly to you, and we will stop the webinar in progress if it's appropriate to be able to ask the question to the group. So feel free to ask your questions throughout the program. I also have one of our sales managers here, Brian Kent. He will also be answering questions. And today we have Kevin Massey. Kevin has been a FAIRWINDS financial advisor since 2014 and an advisor since 2002. He has nearly 20 years of experience, and this enables him to coach and educate members in a holistic point of view using a sound and balanced approach. One of the things that separates Kevin from other advisors is his financial house, which you will be introduced to today. It was awarded a U.S. copyright and is unique to his practice. Using the model, clients are often coached in the areas of asset protection, estate planning, accumulation strategies, charitable giving, retirement income strategies, and special needs planning. And now I will turn this over to Kevin. Kevin?
Thank you, Jennifer. Good afternoon, and good afternoon, everybody out there. Naturally, we're not going to be able to cover all of those topics, and today is really just going to be, I think, a nice introduction to the financial house and people getting their financial house in order. But Jennifer, you mentioned a couple things, being at FAIRWINDS 6 years, and one of the great things about being part of the FAIRWINDS team, our retirement planning team has 8 different financial advisors all around Central Florida and even beyond, kind of coast to coast now. And people can meet with us in person. They can also have web meetings, which of course over the last few months has become more and more prevalent and actually quite convenient for many people. So I view my role here at FAIRWINDS mainly as a financial educator. And the goal, of course, is to get everybody's, financial house in order. And it's different for everybody. So, and Jennifer, like you said, if we do get some, pertinent questions, we want to answer those kind of right away. So feel free to kind of jump in and interrupt me if need be, and we'll try to address it as best we can. So basically, I'll just jump right in because time is limited. And one of the things, we have a title, Helping Members Get Their Financial House in Order. And one of the interesting things is that as we've all been kind of under quarantine and kind of staying at home, some of you who live on the east side of town might recognize this nursery. People, even though they were supposed to stay home, they went out in droves to kind of get their house in order. And this particular nursery was packed. There were just, it was amazing. And I often find it interesting that many of us, we want to do those things which are sometimes pleasurable, and sometimes people are a little reticent to kind of get that financial house in order. And one of the things I think the reason for that is because people don't have a framework for it, and they kind of avoid it. And I'll move to another slide here. And this slide, when you look at it, that is meant to kind of hurt your eyes, meaning there's so many different financial tools and aspects that very often it resembles what I call, the financial junk drawer, meaning whether it's mutual funds or 401ks or estate planning, taxes, CDs, any of these things, it's hard to organize. We're dealing with multiple financial companies, capital confusion, meaning we're just kind of confused by looking at everything. There may be poor asset coordination. Sometimes I meet with people and they have 4 or 5 different 401ks. They're just not coordinated, and it might be better off to kind of combine those. They may have things improperly allocated. They may have the beneficiaries wrong. They may be paying multiple fees, and they may also not be protecting their assets as well as they should. And what I often see, Jennifer, is as a result is that people have kind of this paralysis by analysis, maybe an avoidance, so to speak. And that's, when I got into this business many years ago, I often found that the biggest problem was that people, like I said, didn't have this framework. They were looking at stacks of paper, and it was too confusing. So I kind of came up with a solution. And the solution is what you see here, Financial House. And as Jennifer mentioned, it is a U.S. copyright, which was kind of a special moment for me to get that done, because a lot of thought and effort went into it. And my goal with this was to simplify things, comprehensive, holistic, but make it in a way where people can actually visualize and maybe for the first time fully understand their financial plan. And I've heard people call it, oh, it looks like a game board, or it's a bird's eye view, or it's a blueprint, a schematic. It's like one of those at a glance things. And however you want to call it, it is comprehensive. And it's almost like a kind of a 33-point checklist. And my goal with this is to get people well organized. Once again, easy to understand, make educated decisions. Of course, we want to grow our wealth. We also want to increase our income, particularly if we're in retirement. We want to eliminate inefficiencies and debt, an area where sometimes a lot of financial advisors don't always focus on. We want to focus on protecting what you have. One of the best ways to make money, so to speak, is not to lose it, especially at certain points in our lives. We want to reduce risk. We want to enjoy life. And we want to transfer it and gift it properly. So if you'll notice here in the top left, I call it the present situation worksheet. And to me, that's one of the most important things. So many times I meet with people and they want to do these projections and they want to see, well, where am I going to be in 20 years? Where am I going to be in 15 years? And that really is, it's almost an impossible equation because there's too many variables. I like to kind of coach and guide people to focus on the present and focus on their present situation and make it as perfect as it can be, because that's what we can control. We can't control future stock market recessions. We can't control the housing market. We can't control interest rates per se, but we can control what we do with our overall plan. So a little bit more about the model. When I do meet with people, one of the most important things, of course, is to understand the family situation. What's going on in this box affects everything in the rest of the house. If it's a blended family, there may be some special needs that need to be addressed, maybe with an estate planning attorney. If they're aging parents that you're dealing with, very often, once again, additional situations we maybe need to look into. The roof of the house is designed to be our protection. And if I can get let me get my little red marker here so we can kind of point things out. Auto insurance, homeowners insurance, liability insurance help to protect everything below. Disability protection, income protection, long-term care, medical, Social Security. Checking keeps us from the bill collectors, hopefully. Term life, permanent life, wills, trusts, and title. All of these things help to protect everything below. And that's one of the most important things. And it's something that we can control. The next layer from, I guess you could say, box 11 to box 16, this is going to be more of our liquid cash, meaning money that is readily available to us either immediately, if it's a savings account or a money market account, to within a few days. If we needed to sell some stocks and bonds or mutual funds, we can typically get that cash back in a few days. If it's life insurance, we can usually get that back within a loan within about a week. The layer down here is going to be financial products or solutions which are a little bit more long-term or maybe have some type of restrictions on them. Tax-deferred annuities, pensions, 401ks, IRAs, Roth IRAs, educational savings tools, health savings accounts, valuables, real estate, and maybe a business, or maybe something other. This middle, some people call this the door, is basically where the money comes in, based on your income and your occupation. And then we know some money goes out through the tax rate, money goes out through debt, and hopefully we have a nice high savings rate. In the bottom left, we have debt. And of course, one of the goals is to keep that as low as possible. On the bottom right, we have certain types of trusts. And we also can estimate retirement income. Obviously, it's important to talk about a person's risk tolerance, either for a particular asset or in general. Everybody has different scenarios. It's just important to know. And of course, the thing that I like clients to track on a regular basis, one way or another, is just their net worth. Making sure that we're tracking that, we're trying to build it. And that's the goal here. So what I thought would be good today is to kind of go over two different phases. So whether you're in the near retirement phase or in retirement phase, or if you're in the accumulation phase, I'm going to go over a few things and kind of give some general concepts as to what we should be focusing on. So in the accumulation phase, one of the most important things is to protect. And typically, we want to focus on, like I said, these assets. Let's say it's a young family. They've got a couple of kids under age 5, and they're making good income. We're going to want to make sure that their auto protection is in place, maybe an umbrella policy. We want them to have disability coverage, of course, medical. Where I find most people fail is in the life insurance area and in the estate document area. And it's imperative that we all have our estate documents in order. And that might be one of the things for those of you listening. I would say about 70% of you, just based on experience, have not tackled this yet. And I do go over a few different ways that people can handle this, but ultimately I always recommend that people work with a professional, an estate planning attorney. Some people can get away with maybe trying to do some of these things on their own, but it is always best to work, with a professional. We want to be super savers. We want to make sure that we're saving, and it will be different for everybody. But in general, I like to kind of coach people to position themselves in this way. A good goal is to be saving 15% or more of your gross income. So if a couple is making $100,000 a year, they should be saving $15,000 a year somewhere. And this money could be going towards building up emergency funds, maybe right here at FAIRWINDS, building up retirement assets. Hopefully they're getting a match if they work for a company that has a 401k. They might even be taking some of that savings to reduce debt. We know that debt can be a huge drag financially, psychologically on all of us. And the area that I see a lot of people kind of miss is a liquid multi-purpose investment. And what I mean by that is typically it'll be a mutual fund of some sort, maybe some stocks if they have over a certain amount. But it's money that we have access to, unlike retirement assets, which were kind of tied up till 59 and a half. This money here can be used for multiple purposes. rental properties, starting a business, maybe those kids for college. We use that as the college fund if needed. Hopefully they get scholarships. Early retirement. If somebody's goal is to retire when they're 53 to 55, they need to have a lot of money in this area as opposed to having it all in retirement assets, which they can't touch without a penalty till 59 and a half. So having this balance is very, very, very important. And once we achieve this balance, I find that people enjoy life. And we know that things happen. Look, we know a lot of people recently in particular have come on tough times. They've lost their jobs. Maybe they were furloughed for a period of time, or maybe they have less hours. And that only kind of reinforces why it's so important to have emergency funds in this layer here. And it doesn't all have to be in a relatively low interest savings account. It can be in mutual funds. You can get to those, like I said, within about 3 days. And the goal there, of course, is to for all of us is to maximize net worth. I met with a couple fairly recently, and one of the things they talked about after our meetings was every month they calculate their net worth and they post it on the back of the bathroom mirror. And the goal there is that hopefully the net worth, as they're saving and building wealth, is growing. We know it's probably gone back a little bit over the last few months and maybe has come back up, but tracking that net worth, I think, is really important. So once again, Jennifer, if there are any questions, that pop up, feel free to kind of jump in and let me know.
Hey, Kevin, this is Brian. We're monitoring everything and we'll let you know.
Okay, very good. Thank you, Brian. So what I kind of showed you before was kind of an overview. And what I have here in front of you is typically when I do meet with members and we're doing some advanced planning, we plug all of their data, all of their information, where they have their assets onto the model. And once again, by doing it this way, it should become a lot easier to help them analyze. And we can kind of look at the roof here and we can kind of see, okay, well, there's nothing in here. Maybe we need to address a personal umbrella policy. And by the way, this is Fred, Wilma, Pebbles, and Bam Bam. So I'm kind of giving away my age here with by using them as an example. This is just a hypothetical client, of course. So they've got kids, 13 and 11, and they're one of those 70% of people that have never put their estate documents in place. They've got good emergency funds. They've been savers in their retirement accounts. They've got some Roth IRAs and conservative funds. Over here, we can see they're saving 9%. Their debt to income ratio is 12, and those are all well within parameters that I like to see. And typically, when we do this, we want to make sure we give them a to-do list. People do like to-do lists. So in this example, I would have told them, look, we may need to consider an umbrella policy, may need to consider increasing the life insurance, particularly because they have younger children, get the estate documents in a possible trust in place. They should be saving more. They're saving 9%. They should be saving 15% or more, especially in this scenario. They have very good incomes. They're both making, hypothetically here, $75,000 a year. Maybe shifting some of the cash for potential growth and a special account at FAIRWINDS. So right now, if they have money in a typical savings account, they might be getting 0.3%. But with making some of these adjustments and changes, this is kind of the after. Maybe now, I always like to put done next to any of these things that we have them consider. Maybe they have the umbrella policy. Maybe now they have the estate documents done. Maybe they shifted some of that cash from emergency fund number 1 to emergency fund number 2, but now it's designed to grow at 5 or 6% over time, but they have access to this money. One little perk for FAIRWINDS members, if any of our retirement planners has an investment, has put an investment in place of $25,000 or more, FAIRWINDS members qualify, you can see this right at fairwinds.org on the website, for a special savings account that currently is paying 1.25%. Last year it was paying 2% because the Fed's interest rate was higher. So this is a variable rate, and people should understand that that can go up and down. But we have a lot of members who, one of the reasons that they meet with the advisors is so that they don't have to always play the CD game, that they can kind of park some money there, know that they're getting a good rate of return, much higher than the national average, and that their overall plan, of course, is better. Of course, being debt-free at 65 is important. Long-term care, maybe prepaying the mortgage. And of course, retirement income strategies are always important in the future. So once again, just wanted to, and in this scenario, with some adjustments, now they're saving 17% and the debt-to-income ratio stayed the same. And maybe we reallocated their assets so it's a little bit more appropriate for somebody with 15 years to retirement. I also have this. I didn't go over this. People often ask, hey, am I on track, Kevin? And I found this, and it seems to be a very good way for people to kind of see where they're at based on their income levels. So if Fred and Wilma are in their 50s, they should have a net worth approaching 5 times their income. So if their income is 150, their net worth target should be around 750. Currently, they're at 615, so they're a little bit behind. And often seeing that creates a lot of incentive. A lot of people say, well, Kevin, we want to change things, we want to adjust things, we want to get ahead of the curve. We don't want to be behind the curve anymore. And once again, that's the importance of kind of tracking net worth. Now, of course, if somebody's income goes up, if all of a sudden they're making more money as a couple, then these ratios are going to change. But I do think it's important that people track these things and once again do it in a way that's in the present position. We can always do projections, but focusing on the present, of course. Now, for those retiring in the retirement phase, same house, same game board, but the objectives are going to be different. For example, when we go to the protection phase, we're still going to want homeowners protection for lawsuits, auto protection as long as we're driving, and we're still going to want an appropriate umbrella policy, and that's for most people. If we're retired, we certainly don't need disability insurance anymore. We're not working. But that transitions over to some type of a long-term care strategy. As someone whose family has experienced the need with a parent for long-term care coverage and protection, it can be very, very expensive. There are multiple ways of handling it. And that typically is a meeting in and upon itself. And there should be, with any financial advisor, whoever you have, there should be a discussion if you're nearing retirement about long-term care strategies. Some people don't need to worry about it. They've got so much cash on hand, they can self-insure. Some people, if they don't have much in the way of assets, they may have a different strategy when it comes to Medicaid or something like that. But people in the middle very often have to plan if they're trying to preserve the estate. At this point, they're collecting Social Security. Of course, there's always the decision as to whether they take it early or they postpone it. We definitely need professionally done estate documents, trusts. We want to make sure everything is titled properly and there's beneficiaries on accounts. Maybe life insurance, particularly if long-term care strategies are needed, or sometimes for pension planning. But now, when it comes to we're not necessarily putting money away into our assets anymore. Now we want our assets to work for us. And sometimes we, of course, continue to work part-time, maybe in retirement. But the flow of money and the buckets of money may kind of stay the same. Meaning, if we like having $50,000 of emergency funds, we maintain that. If that grows, because it might mean we're not enjoying our money, we're not spending enough. If our emergency funds are being depleted, it means we may need to look at, tweaking our assets so we have more income coming in. But for the most part, people want to enjoy their income. People in retirement who have zero debt, that should be the goal for everybody, because then you, aside from taxes, you own your plan. And what I mean by that is one of the big conversations I have with members nearing retirement or in retirement is, what are your philosophies when it comes to your estate? Do you want your assets to continue to grow so you leave more for the kids, charity? Do you want to scrape off all the dividends and interest? And so if you retire with $2 million, you live off of that, and then you leave $2 million 30 years later? Or do you want to deplete it to zero and enjoy more money while you're living and leave less for your kids or for charity? And that's a big decision. Most people I find are kind of in the middle. They're not necessarily looking to leave all their money or grow their money for kids or family. They're certainly not looking to spend it all. Most people are going to be in the middle, but everybody's situation is different. And a good financial advisor, a good retirement planner are going to be able to help you look at strategies for all of those scenarios. Another thing, and also very big with FAIRWINDS, we kind of call it along with the FAIRWINDS way, is being charitable, meaning being charitable either with our time, or if we've done well financially with our monies. And very often, this is where some of these special trusts come in place. I've had a number of clients who set up what we call charitable remainder trusts, where they take an asset, it might be some stocks, it might be some land, and they literally gift it to a charity of their choice. Could be an alma mater, it could be anything. And while living, that charity pays them an annual amount. But when we pass, that asset then goes to the charity. Legacy estate planning, once again, is all part of the discussion. Very often I do meet with families, and they have great incomes coming in. They've got more money coming in than they can spend. And if they've got grandkids, sometimes as part of their legacy is they set up educational savings accounts. Or every year, come the holidays, they gift a certain amount. And if we can all get to this position where we're able to be charitable, when we're able to give, those are very often some of my happiest clients, because they've truly achieved financial freedom, where now they're able to help others and other charities, of their choosing, almost in a way becoming philanthropic. I'm not going to go into this too much, just because of time. We're about a half an hour in, and I want to make sure we have time for questions. But in general, let's say we were looking at Fred and Wilma Flintstone, and we were doing projections to age 65. This house would have done, based on how much they were saving, based on how much they were putting in, and based on assumed rates of returns. We know those returns could be higher. We know they could be lower. Their hypothetical asset total would be around $2.4 million. Of course, the goal would be zero debt, appropriate protection always. And a good rule of thumb is if you can retire with 70% of your pre-retirement income coming in, if you're debt-free, you're probably going to have more money than you can spend, or you're certainly going to enjoy spending it. So in this scenario, if Fred and Wilma were making 150 and they were expecting some increases in income, and they thought they'd be making about 170 a year at 65, if we take their 2.4 million of assets and we remove their home and emergency savings, because we never want to touch those, right, unless we downsize, and let's assume a 4% rate of return. dividends and interest. That would generate about $72,000 a year. And then once again, these are just estimates. It's different for everybody. Social Security for Fred, Social Security for Wilma, maybe a pension. In this scenario, that are $138,000, and they're at 80% of their pre-retirement income. And of course, at this point, if we're retired, we're not putting money into the 401k anymore. Hopefully, we no longer have that mortgage. So we can use the house and we can do projections. But like I said, all they are projections. However, if somebody is ready to retire, and let's say they are ready to go, and we're actually taking their assets and we're designing a plan, this is what I personally would use. It's something that I put together, and it just helps us look at different assets. Let's say they've got Social Security, investment income where they're just scraping off the dividends. I'm a big fan of kind of coaching, and maybe get a little cursor here, nudging people to maybe spend and enjoy some of their money while they're healthy enough to do so. When we truly study retirees, we don't always need these increasing incomes in retirement. Typically what we see is most people will spend more money in their first decade of retirement than they do in their second decade. Then they spend more money in their second decade than they do in their third decade. The only thing that might alter that would be health issues, lawsuits, things like that, which could be damaging. So I have a checklist that I use for people, and we use this to kind of plan. And typically what we look at when we do this type of planning is, well, how much am I going to enjoy? If I hypothetically live to 95, how much are we leaving to the kids, and how much are we leaving to charity? And of course, that's going to be different for everybody.
Hi, Kevin.
Yes, Jennifer.
Hi, we have a question from the audience. How do you figure RMDs into the house? Where would you put those?
Well, RMDs are going to be, we're talking about taxes. So everybody's scenario is going to be different. What this model does is it does a holistic view. If somebody doesn't need their required minimum distributions, let's say, and thankfully now, people can wait till age 72. What I like to do is, and this would not necessarily be, we would maybe use a printed version of this and kind of say, hey, we're going to move money from here to here, or we're going to move the money from here to here. But I do like retirees to have what I call a retired minimum distribution bucket. So let's say somebody had to pull out $50,000 in required minimum distributions. They've got to pay the tax on that money, because if it's a Roth IRA, of course, there are no taxes. I see most people putting that into low interest savings accounts. But what if we could set it up where the RMD comes out, taxes are paid, and then automatically it goes to their non-IRA investment, meaning we never see it, it never hits checking. And the benefit there is if we live to 95, if we live to 100, quite honestly, your 401k, your IRAs are probably going to get depleted. But that doesn't mean we can't grow the after-tax amount somewhere else. So the house model is designed to do planning when it comes to looking at RMDs, when it comes to looking at a tax, then we use other types of tools. So hopefully that answers the question. So that is whoops. Okay, so basically my overall goal with folks, and once again, remember today is designed to kind of be an overview, comprehensive overview. The goal is comprehensive, holistic retirement plans using simple products people actually understand. And when people do what I've been doing for the last, my goodness, few months, let's say they call and they schedule an appointment and we do a web meeting. They'll literally be looking at this version. This is kind of the initial version. And within about 10 or 15 minutes, they're going to be looking at this, meaning by asking some questions, we ask them about their home, they may downsize, we ask them about cash on hand, they've got emergency savings, 0.4%, they have some CDs which are renewing at a low amount, they've got some Johnson & Johnson, of course this is just an example. We review their protection components. We can see that they've got some holes in the plan. There may be things they need to consider. And we go from there. And like I said, it's going to be different for everybody. But my promise to people I do meet with is to give them a checklist, to give them a one-page holistic review first, because we need to put these things in order. I will very often meet with people, and I think this is a good way to kind of start to summarize things, at least my philosophy. And they all want to talk about rates of return. They're all upset because their CDs aren't paying that much, or their emergency funds, aren't getting that much. And when I do this review, I will come right out and say, Mr. or Mrs. Client, I do not want you to schedule another appointment with me until you go get your estate documents done. Mr. or Mrs. Client, we're not going to talk about your RMDs yet because you're 70 years old. You don't have to worry about this till 72. You need to go get an umbrella policy to protect this $400,000 here, which is exposed in an accident. Mr. and Mrs. Client, we will talk about your wealth, but shouldn't we also address the fact that you don't have a long-term care strategy in place? So I will hold a pretty strong line, and it may be different for different advisors, that we address the protection component at the same time we address the financial component. So if I look at this right here, I see one item for the checklist, 2 items, 3 items. Something can be done here. These probably need to be reviewed. Why not just pay off the mortgage, do a credit freeze, come up with strategies to increase retirement income, maybe start even looking at charitable giving potentially, and then we can dig into the details. So I think that's a good, hopefully good overall review of the financial house, simplifying things and making it visual. And one last thing I'll say, and then Jen and Brian, I'll ask if they're in. When I do meet with people, everybody takes in information differently. I meet with some people and they're extremely visual. Other people, they need those proposals. They need those prospectuses to review and go over. They're highly analytical. But what I do find with couples, if we're dealing with a couple, is that very often they view the finances differently. And I would say 50% of the time that I do meet with couples, they'll end the conversation with thank you. You know, for the first time, we're both literally on the same page financially, and we both understand and we can kind of see it. And that, of course, is important, you know, for both husband, wife, spouse, partner, because, you know, tomorrow's not promised for any of us, and we want to make sure that everybody, the family, maybe sometimes the kids are involved. And of course, you're welcome to call us, 407-282-6039. That is our retirement planning department. And we have, like I said, 8 advisors, 9 advisors that you can schedule either a web meeting, a phone meeting. You can schedule a meeting with me and we can kind of go over the house together. It's complimentary for our FAIRWINDS members. There is not a cost to do so, but you do need to call in and get that financial house in order, so to speak, and make that appointment.
Right. Thank you, Kevin. They can also go to the fairwinds.org website and select schedule an appointment and schedule a retirement planning appointment, which can get you to one of our financial advisors as well. Thank you so much, Kevin. Enjoyed seeing that version of your house again.
My pleasure.
The house, and just so you know, the house is available with Kevin, and we do have other advisors as well who you can meet with, but in order to use the house, that would be solely with Kevin. So, but thank you so much, Kevin. That was a great lesson in holistic planning. So thank you.
Thank you. My pleasure. And hope everybody out there has a great day and stays safe.
All right. Thank you so much. Have a great day. Stay
Bye-bye.
safe.